you suggest that someone seeks, that conversation with a financial planner? Like, does a person have to have a certain sum of money or investments or assets before they even take that step?
Yeah, it is in this environment, unfortunately, an environment where most financial planners are going to require some investable assets. Financial planning is more like a loss leader. They don't see that as a major focus in their industry, as a way, as a means to get to investment assets where they can charge a fee for their investment advice. We're not, unfortunately, working from a position of trust, and that trust and that question of trust has been, earned, unfortunately. So my firm is mostly making a fundamental change in the way we do that. So if you work with younger folk, and my focus is X and Y generation people who don't necessarily either want to have investments invested or don't need one, I can help you with the non-investment related financial planning questions. So I can help you with figuring out what is the right offer that you should accept if you're moving states. I can help you figure out whether or not a health savings account makes sense for you and your tax bracket. So these are really important, and even, I would say, even more impactful things for you as someone who's younger than the investment piece. So at my firm, you get a combination of the two choices. You can have the financial planning piece, the investment planning, financial planning piece, or any combination.
Okay. Is there any person that it doesn't work for? Like, is there a person or a certain profile that will come to you or come to a financial planner and they'll just laugh at them and say, you shouldn't even be having this conversation?
Yeah, there are some people that are cynical, and I definitely believe that some, like I said before, we've learned some of the distrust, earned some of the distrust that people have experienced with us. But speaking for myself and the people I find that are focusing on the things that are important, I think everyone could value or get some kind of value from financial planner. And I say the biggest situations where you could need one is when you have a major life change. Maybe you're going through or about to approach retirement. That's a major one. If you're having a child, that's a major event. If you're getting married, that's a major event. You want to kind of get together, you and your spouse or potential spouse, and figure out what's important when it comes to money. And having a plan together is something that a financial planner can talk you through, because there's a lot of questions when it comes to that.
What about, there's a group or an audience, even college graduates, getting their salaries regardless of their profession. They're about to get a salary higher than what they're used to being paid, or maybe, they weren't as a college student. Do you suggest these folks also go into a financial planner to, to basically say, hey, I'm about to start getting money that I'm not accustomed to. How do I manage that money and how do I allocate that money?
Yeah, absolutely. From a wealth standpoint, there's no bigger part of your wealth as a young person than your human capital. So how you deliver that and how you manage that is wealth management, right? So my focus on my firm is also in career development. So I'll coach you through how to negotiate a retirement package, how to negotiate an offer, how to make sure that when you're going through the enrollment process of getting into your plans, you're making the right choices. So these are very impactful things that you can get some assistance and support for. And so those are topics that I'm certainly able to talk with people.
Awesome. Generally speaking, your firm or other firms, is there a cost associated with that initial conversation? What does that look like? Just from a consumer standpoint or from a customer standpoint, what does that look like?
Yeah, in 1981, there's a firm in Florida. Gosh, I can't remember the name. They actually originated this model, and it's a subscription model. It's very, very new to the environment and the community, but that's the model that I actually offer. So for the first 30 days, you could have a relationship with me where you're paying about the price of a mid-size or mid-quality gym membership. And with that with that type of opportunity, you don't actually have to have any investable assets. You don't have to make any kind of long-term commitments beyond a month to month in the first 6 months.
Awesome. And within that, I mean, what does kind of a person get, or what should a person expect to gain knowledge-wise by the end of that 6 months?
Order is the biggest thing that you're going to get out of that conversation. So I'm going to help you understand that what should be important, but what is important to you, and then from work backwards and kind of help you figure out a plan to get to where you want to be. So you'll have a written financial plan, a net worth and balance sheet provided to you, and then you'll also have a map, a roadmap that I'm going to help you deliver, and it's an ongoing relationship. So as you have questions, I know some people, they might be looking on TV, they might have a question, they might have read it in an article. You'll have the ability to just call me whenever you need me. You have somebody that knows your situation and can actually answer your questions real time. So it's real time advice, a financial plan, and a roadmap to really where you want to get as your needs and your values change over time.
Awesome. Having worked with people on their financial plan or managing their wealth, what are some of the biggest changes or advancements that you saw in people's lives as a result of the work that you do with them?
Yeah, I can. You're gonna cut this one out.
You want to repeat that question?
Yeah,
We can move past that.
Okay. Yeah, let's go past it.
Okay. So what are some key do's and don'ts when it comes to thinking about and structuring your long-term financial or investing strategy?
There's a few, but I'll point out three big ones. The first and foremost is that the goals have to be yours, right? Life is long. When you're trying to achieve your goals that you think are expected of you instead of the ones that you want, it's going to be really hard to accomplish those, right? And you'll feel dreadful trying to get through the ups and downs, the challenges that are there if you're not really emotionally big in and bought into those ideas. And I've heard many octogenarians, just to be just as miserable, having accumulated a large amount of wealth without any real positive memories of things that they could have done with. So it's for me a collaborative process when I work with my clients to figure out what they want, and don't assume, and just really ask those deep questions and then make sure that they're on track for those goals that they want. On the other side, life is again tough. You got to stay motivated. You got to talk to your spouse. Right? So make sure that you don't plan independently, right? It helps that you have the conversation about what money means to you and your spouse, so you can plan together and not in a kind of a silo. And I'll say the last one is I take it from an old Chinese proverb that says that the best time to plant a tree was 20 years ago. The next best time is today, right? So
Right.
Don't look at the pundits who talk to you about, oh, you could have done this, was this what you should have done when you were 18, 20. That's the past, right? Abandon all hope that you can change the past, right? But you got to do something today. So that I would say those are the main things to do. The more important things are keys for you to think about.
Awesome. Any big don'ts, especially for young people? Like, I mean, I'll just say an example. I don't know if it's right or not, but like, don't buy a Lamborghini the first big check you get. Like any of those big don'ts that you see a lot of people, especially young folks, falling into.
I definitely agree. I think a second year, third year car when you come out of college is certainly something worth looking at to start, right? Save your money. Depreciation is going to eat into that car with the moment you drive off the lot. And there's so many other things that you're going to want to have your money go towards. You're going to probably buy 12 or 13 cars in your lifetime. You're going to be able to get in your 40s and 50s that car that you always really wanted if you stay on track and you stay on goal. The other thing I would say is think about what you want to do in your career, and don't be afraid to say you don't know. It's all right not to know, right? You don't want to get through your first year of your master's and looking at a huge amount of debt uh, because you decided to go straight from bachelor's to master's, and then only to realize that, oh my goodness, I really don't like this career. So figure out what you want, and then have some idea of what you need to do to get there from an education standpoint, and don't rush. The other thing I would also mention is, for every $10,000 you borrow, you should expect your income to raise by $10,000, right?
Okay.
So think about your master's, for example, just back of the napkin math, just rule of thumb, if you're going to go into debt $30,000 to get your master's, and you're making $80,000, make sure that you're going to get a job where that master's is going to give you an opportunity to walk away and get an opportunity for new jobs. They're giving you $110,000, $120,000 or more salary. So those are some of the things that we can discuss, and it's more personalized, the type of guidance and advice I give to people, but that just gives you an idea.
Awesome. No, that was a great one, man. That was a great one. Can you repeat that rule of thumb again?
For every $10,000 in debt you accumulate, you should expect to have that $10,000 in an added increase in salary.
Awesome. Yeah, I think that's a big one that a lot of people overlook as they accumulate debt. What are some resources or just general sources that you can recommend to people that may just want to read or learn before even seeking a financial planner?
There's a few, and I really do believe, not just in finance, that this rule applies to everyone, is that you want to be reading. Just try to make sure you read, read a book a month, read a book every other month, whatever the case may be. And as a younger generation, especially the younger generations, learn history. Nothing is better to help you relate to the people in your job that are older, coming through from other experiences, or understanding the market and the context between returns that people experience in the market. Nothing is more important than understanding history. So for instance, every market cycle, which is from a bottom of the market, recession, depression, into a recovery, to a peak, to again, another recession, the tops are usually typically higher than the prior tops, but each one ends differently. So having an understanding that, hey, history doesn't repeat itself, but it rhymes, means that you can learn and kind of avoid some mistakes and pitfalls that many people have made from cycle to cycle.
Cool. Awesome. I'm taking some notes myself.
Yeah.
Few questions that kind of came from a few groups, and I'll just jump right into them. For someone who invests in real estates, would you suggest that they take their profits from their real estate investments and put it into a retirement plan or a retirement account? And or what are your recommendations of how someone should deal with their profits from real estate investments?
Yeah, so there is a special feature, and Mina, you probably deal with a lot, is called a 1031 exchange, where you can actually take some of your profits that's specific to real estate and roll those over into new real estate within a separate, within another certain period of time, right?
Right.
So that's one approach. The other thing is, I've recognized people are aging, right? So I have had situations where people become older, they physically aren't able to manage their property. You can actually take those groups of properties and actually go to a real estate investment trust, which is almost like a mutual fund for real estate, and offer that as a block as a whole. And in return, in a non-taxable way, you can be exchanging those houses for shares of shares that just go in your brokerage statement. So, that's one approach. I will say real estate is a diversifier, just like anything else into the market. So you want to have a sizable amount in different variable types of investments, right? So if you feel comfortable with that level of complexity, that's great. As you age, you might be unwinding and investing in real estate. You have SEP IRAs as a person that's in real estate that you can invest into for retirement, even if you're doing it on your own. You're not working for an individual company. So there's a number of different retirement approaches you can use and save yourself some money on the taxes. And then you also have the ability to invest in some more specialty types of real estate through real estate investment trusts. So for example, if you wanted to, I don't know, invest in multiple family homes, and maybe you don't want to have your assets tied up so much into that property, you can do that through real estate investment trusts, which are like stocks for real estate.
Anything someone should be cautious of if they're taking like real estate profits and just kind of building up their retirement account?
One thing you want to be cautious of is that, yes, real estate is a diversifier, but when there's a broad-based decline in the market, correlations between, that is, the movements and the patterns of performance between stocks and other risk assets like real estate tend to line up. So it isn't a perfect diversifier from a broad-based decline in the overall economy. And sometimes that translation is lost sometimes. You know, you could get investments into real estate. You can invest in real estate investment trusts. The patterns are going to be similar. And also you got to have an idea that you're looking at the long term. You know, nothing goes in a straight line.
You talked about diversification, and this is not a question I posed to you earlier, but I see it as a big debate online, and I really don't know if it's a debate, but you know, people always say, you know, stocks versus real estate, right? And I don't know if that's really the right question to ask, because as you mentioned, there's a diversification factor. So can you just shed some light on, if someone comes to ask you, hey, should I buy stocks or should I invest in real estate? What do you tell them, or you know, how do you kind of bring them backwards to think about the bigger picture?
Good question. So I want to clarify what they mean by invest in real estate. If they are buying a REIT, or they're not going in and going through the house, they're a strictly investor, they're not actively participating in it, I would say that risk is a little bit higher, right? Because you don't know what you're doing, you're not actively involved, it's not your job. But if you work real estate like you're, say again?
You don't have control of the position. You can't dispose of whenever you want.
Exactly. Now, if you're investing in real estate and you're an active participant in managing that, that's a job, right? So how much you can put into your wealth in that, you'd be treating it almost like a combination of an investment and a job. So it's not a apples to apples comparison to an investor who's not engaged at all in trying to determine what level of risk is involved. Now, with that being said, it's always good to have money, safe money, your emergency savings, right? Money that you have set aside for an emergency, and then some other unrelated investments that aren't going to go with the same pattern of performance with the overall real estate market.
Okay. What's your opinion on real estate investment trusts with relations to building wealth? I know you mentioned real estate investment trusts a few times. Mm-hmm. Is it a suggested strategy for someone to invest in real estate investment trusts in order to build wealth?
I think it is a beginner's way to get access to real estate when they do not have the time or the interest or proclivity to invest in real estate directly. And I look up to you, Mina, who have the time. You're really engaged. You love it. You know, you roll up your sleeves and you can make a really decent living doing that. But no, if you're an accountant or you're in a boardroom, or you can't actively evaluate these individual issues, or you want to get into a specialty area of the market without having a large amount of money to invest, that's where a real estate investment trust could be. I mean, you can buy a share of your local mall or a apartment complex for a few dollars and no commission at some of these places. So that's why you would look at real estate. If you don't want to be actively involved, but you also want to participate in real estate's appreciation, that's the way you would invest in a real estate investment trust.
And how does that work just for a beginner? Are they bought and sold like stocks? Is it easy to buy and sell shares of in real estate investment trusts?
Absolutely. So you can go to your local broker, whether it be a Fidelity or Schwab or TD Ameritrade. You can open up an account and then you make a deposit and then you'd be buying shares of that in the open market. So there's professionals who are the advisors for a pool of assets with your assets and others. They're strictly investing in real estate products, mortgages, or the equity in those properties. And so they get broad diversification, they get scale, which is important, and that reduces costs, right, and friction. And then through your ability to look at pricing and marketability, you have an easy way to get in and out of the market, in the market of real estate through those vehicles.
Okay.